So we're doing very well with China. We're talking to China. We're not ready to make a deal, but we'll see what happens. But, you know, we've been hurt by China for 25, 30 years. Nobody's done anything about it. And we have no choice but to do what we're doing. It's working out very well, as you know. We called them on manipulation, and they brought their numbers back. And they brought them back rapidly, and they were able to do that because they manipulate. But that's all. It's called monetary manipulation. Not good. But what happened and what's happening with China now, we have an open dialogue. We'll see whether or not we keep our meeting in September. If we do, that's fine. If we don't, that's fine. But it's time that somebody does what we're doing. And I said the American taxpayer is not paying for it. We had a big day in the stock market yesterday, but the American taxpayer is not paying for it. What China's doing is by depressing their currency and by pouring tremendous amounts of money into their system, they're paying for it. The prices have not gone up. So when in fact, in some cases, they've gone down because the devaluation plus the money supply, the amount of money that they pour in, which is a form of manipulation, has more than compensated for an increase in price. So as I said, and everybody questioned it, in the case of China, the tariffs have been amazing. We're taking in billions and billions of dollars. Now, China's had their worst year in 35 years now. It was in 26 years, but now it's in 35 years. I want them to do well, but as of this moment, they're having the worst year that they've had in many, many years, in decades. And really, we're just bringing the system back into order. We have all the cards. We're doing well. Our country is doing fantastically well. You look at Europe, they've got problems. In fact, the biggest problem we have is the fact that a lot of other continents, frankly, but a lot of other countries are not doing well. But we're doing great, and we continue to do great. Our companies are poised. They have a lot of cash. Our system is beautiful.
Peter, thanks for being with us today.
Good afternoon, Sarah. How are you? Wilfred?
I'm okay. We're sort of all digesting the week that we just went through. It was crazy. It was volatile. And it was marked by an escalation of tensions, both from the U.S. and China in the trade war. How much farther are we now, Peter, from a deal?
Well, let's look. The Dow ended up for the week about an 800-point bounce off its Wednesday low. We're in striking distance of the high on July 15th, and I think investors are clearly and correctly seeing a chessboard in which a strong Trump economy, strong earnings, and the prospect of more rate cuts by the Fed are what's important, as well as passage of the USMCA in the fall. So I'm bullish on this economy. I'm bullish on this stock market. On the China issue, I think any time that I talk about it or that you talk about it on the air, I think it's useful to start from the problem that we're trying to address with China. It's basically 7 acts of economic aggression that are built in structurally to the Chinese economy, and they're worth going over. It's the cyber intrusions into our business networks to steal our trade secrets. It's the forced technology transfer in exchange for access to the Chinese market. It's intellectual property to the tune of several $100 billion a year. Dumping of products below cost into our markets, which put our factories and jobs out of business. We've got the currency manipulation problem, massive subsidies to state-owned enterprises, and the 7th act of aggression, which the president takes very, very seriously, is the made-in-China fentanyl and opioids that will kill over 100 people today, over 1,000 people this week, and over 50,000 Americans this year. So when we're negotiating with China, these are serious structural issues. This is not a trade deal where they lower their tariffs, we lower ours, and everybody lives happily ever after in the Ricardian model. This is about structural change that I think the president has taken a very strong stand here. He now has bipartisan support on Capitol Hill, as well as support of the American people. And if we can bring about these structural changes with China, it's going to be good for China. It's going to be good for the United States. It's going to be good for the global economy. We can't live in a world Sarah and Wilfred, where China cheats and treats us like a piggy bank and transfers over $500 billion of our wealth a year. So that's where we have to start when we talk about the deal.
Sure, we get that, and there's a very wide range of topics, as you said, being discussed here. But let's focus in on the currency aspect. Sure. It's been front and center over the last week. Do you want to see China allow its currency to free float? Because almost every analyst suggests that would see the currency weaken from here, not strengthen.
So I understand that argument very clearly, but here's also what we know here at the White House. Since the tariffs were announced last year, the Chinese yuan has fallen by about 12%. So we put on tariffs around 10% on $200 billion of their exports, and they devalue by over 10%, basically to offset that. And then to deal with the rest of the tariffs, they're cutting their prices, and they're doing that. So that's what we see. So clearly they are manipulating their currency from a trade point of view because they're taking actions to neutralize our tariffs.
Why is that clearly they're manipulating? If you put tariffs on another country that is slowing their growth and slowing their export and manufacturing sector worse than ours, then that would argue for a weaker currency. I mean, that's the market.
So actually, look, China basically put the smoking gun right into its announcement when it said it was going to stabilize the currency when it let it slip past the threshold of 7. It said, it almost bragged about how it was highly skilled in being able to set the value of its currency. So we take them at face value. Sarah, you know that there was a long history from roughly 2003 to 2013 where China was viewed as the worst currency manipulator in the world. And the problem with their currency manipulation...
But they kind of wrapped up in 2014.
Well, yes. And what happened was when President Trump took office, promising in 2016 as a candidate that he would brand China a currency manipulator, it was on its best behavior for a while. But the facts don't lie here. Seek truth from facts, Deng Xiaoping. Since we put the tariffs on, China's has devalued its currency by over 10% with the express purpose of neutralizing the tariffs. Full stop. So what we need here, this isn't good for China. We're seeing China, they lose when they devalue their currency on their capital, but we're also seeing the supply chain moving swiftly out of China. Some of it's coming here, which is great. That's more jobs and factories here. Some of it's moving to other countries in Asia, Vietnam, Malaysia, Indonesia, Thailand. That's good for the global economy because it becomes a more diversified supply chain. So this is what we're grappling with. And the 10% tariffs that will go on September 1st on the remaining $300 billion worth of goods. We'll see exactly what happened with the first $250 billion. China will bear virtually the entire burden of that through their currency manipulation and by slashing prices. So this is where we stand. And I think I want to emphasize here for investors that this, of course, is an important topic. But what really matters for the market over the next couple of months going into the holidays really is going to be how fast the Fed is going to lower interest rates and really whether we get the United States-Mexico-Canada agreement. And the Fed lowering rates, to be clear, is really important for two reasons. One, since Jay Powell was appointed chair, we saw the rates go down by 100 basis points. We've come back 25. But what that's done is suppress investment directly in our GDP equation, and indirectly it's suppressed our exports through the currency effects. And so we had a 2.1% Q2 growth rate. We saw 2/3 of a point lost to reduced exports, primarily because of the Fed's currency effect. And we saw commercial real estate, for example, lose us about 0.2 of a point because of the higher interest rates and uncertainty over Fed policy. So these are the kinds of things I think if you're an investor, you want to see the whole chessboard. And we had some volatility related to the China issue earlier in the week and at the end of last week, but investors are seeing through that, and this is a bull market and will continue to be so.
Do you think the Fed, do you think Jay Powell's purposefully trying to stifle growth in order to hurt the president?
No, I don't think so. I think Jay Powell made a rookie mistake. Look, I've seen this movie before when we went into the 2001 recession. This is, by the way, for your viewers, this is what I did for a living for 20 years, often on CNBC, talking about macroeconomics and Fed policy and how that would affect the markets. Back when we had the 2001 recession, one of the problems was Alan Greenspan didn't understand that we were having an amazing technological boom and we could hit a 4% growth rate in that environment. So he raised rates and basically choked off growth. I think what Jay Powell didn't see was the fact that there's tremendous power in President Trump's economic policies with respect to deregulation. That's a pure positive supply shock to the economy. It lowers business costs. And so what Powell, I think, might have been thinking was it might be hard for us to sustain growth at 3% without causing inflation. But guess what? It's easy to do in the Trump economy. And we look at core inflation right now. It's 1.6%. We look at the inflation rates that matter from 2018 to 2019. They have fallen. We can get to 3% and above growth rate if Jay Powell lets us. I liken this problem that the Fed has put on us like a governor on the old school bus so that it couldn't go more than 50 miles an hour. We've got a Ferrari here that President Trump has designed with tax cuts, deregulation, cheap energy, and a fair trade policy. And we can get to 3% or higher easily if we have Jay Powell and the Fed lower interest rates and let investment come back in the way it should and have our exports thrive like they should.
Let's talk about the next round of tariffs, Peter. That surprise tweet, which also spooked the market. September 1, the remaining few $100 billion of Chinese imports, mostly impacting consumer goods, apparel, toys, iPhones, laptops. Are you guys still going to really argue that the American consumer and American importers aren't going to pay for this?
I am going to argue that, and I'm going to recommend that your viewers find a guy named Jerry Storch, who was on TV today on a financial news network, who gave, I think, the most elegant and eloquent view of why these tariffs won't be passed on to consumers. He's the former president of Toys R Us, who worked a long time in China and with China because China is the toy capital of the universe. But basically, what's going to happen and what is happening with the first $250 billion is China's going to continue to devalue its currency. It's going to slash prices, and suppliers are going to move to other places like Vietnam and Malaysia and Indonesia and Akron, Ohio, and we're going to be able to basically buy those consumer goods at barely more than we otherwise would have paid for. You can point to no...
So you do want them to devalue their currency?
No, I don't want them to devalue their currency.
You just said that they're going to, so it's
well,
going to offset.
They're going to, and we're going to take strong action against them. But what I'm telling you is that this is how the Chinese are dealing with it, and they're hurting themselves. They're hurting themselves. I mean, this is what... Here's, I think, what's interesting about this whole thing. While China is cutting its prices and cutting its currency to try to maintain its exports to the U.S., it's missing the bigger macro move here, which is the offshoring of production from China now back to America and to other countries in Asia. And so I think Wilfred, that this is something that will play out over the next couple of months. We continue to plan to have the Chinese negotiators come here. And one thing I'd like to, I've always wanted to have a rule named after me. So I want to maybe introduce the Navarro rule today, and it comes in two parts. It's basically that anything you read in the newspaper that has unnamed White House sources will not be true. And the second part of the rule is anything that you read about China or trade policy, if the following people are quoted, it won't be true. And that would be Treasury Secretary Steve Mnuchin, USTR Robert Lighthizer, Commerce Secretary Wilbur Ross, or the NEC Director Larry Kudlow, or myself.
What are you referring to? Are you referring to reports that you guys all disagree on where this policy should go? Because according to the latest reports, you were the only one in that group that was actually in favor of putting these new tariffs on.
I'm referring to a lot of stories that I've seen, and the point I want to make here, Sarah, and this is so crucial for your investors. We are going to negotiate this deal behind closed doors, and it's going to be done on our side by Robert Lighthizer, the best trade rep we've ever had in our history, with Steve Mnuchin at his side. And there will be Chinese counterparts there, Leo Ha, and he'll have his people there. What happens in that room will not leak beyond that room. The only other people that will be involved will be President Trump, Wilbur Ross, myself, and Larry Kudlow. And none of us let things get out there. And what I've seen far too many times are these strategic leaks from unnamed sources, which are designed to try to get us to reveal what actually is going on, when in fact 99% of the time it's fake news. It's so important for me, the Navarro rule. Please don't believe anything you read if it's unnamed sources, because these people are malicious and they're usually wrong.
Peter, to that point, we do appreciate very much you coming on so that we have you here on the record. So thank you again for joining us. I want to ask you about what cost is worth paying to get the result that you really want ultimately at the end. So we've seen an elevation, a tit-for-tat elevation over the course of the last week. Potentially, of course, there could be further elevations and escalations in the trade war to come. If that meant the U.S. briefly in the short term saw GDP contract, would that be a price worth paying to get the long-term settlement for the future of the U.S.-China trade relationship?
Well, here's what I know. First of all, the American people are clearly behind the China tariffs, and they understand that question. But the Harvard-Harris poll, which I think is the best poll on that, shows a strong majority of Americans support that. And we also have a rare bipartisan consensus on Capitol Hill that we need to stand up to China. But the really good news here, and this is President Trump understands this probably better than anybody in this country, is that China is the one that suffers far more harm than any might be inflicted on us, because they're sending us $5 of exports for every $1 we sell them. And I would point to you, Wilfred, to the Q1 2019 real GDP numbers, where we hit 3.1% GDP growth, and fully 1 point of that growth was due to our reduction in our trade deficit, primarily with China, primarily because of tariffs. And my point is simply that we have a lot more to gain, both in the short and long run, from bringing about structural change, ending those 7 acts of aggression.
But if it did start to lead,
that's a hypothetical, and I'm not saying.
I get that. But I'm saying if that was the case and the U.S. started to lead into contraction, would that be a price worth paying to continue to push in that direction?
My point is, Wilfred, I don't see that scenario. If we lower our trade deficit with China, we grow faster. Yeah. And by the way, I think we're at about $36 billion of tariffs collected on Chinese goods. And by the way, President Trump promises every American farmer that you will be made whole. You will not be hurt by China. He will not let China bully farmers as a way of having their way with this country or this economy. So right. I think we're at a point now where people have to be patient, let these negotiations take place behind closed doors, follow Navarro's rule, and don't believe anonymous sources in newspapers. And in the meantime, let's focus on good Fed policy. You can't have a 200-plus basis points spread between U.S. interest rates and the rest of the developed world and expect good things to happen. That has to change. And let's focus about USMCA. I mean, I would love to see CNBC do a whole week on USMCA, go out into across this great country where these congressional districts are and talk to people about the importance of getting it. Because this is a deal, it's an interesting trade deal in that it helps every constituent, farmers, ranchers, manufacturers, and workers. You know, some trade deals in the past have pitted farmers versus manufacturers or vice versa. This is a home run win. It would be the largest trade deal in world history. It's the most modern trade deal in world history. It's designed explicitly to bring manufacturing back to the United States. So let's get it done.
Peter, we do on CNBC talk a lot about the importance of the USMCA. But you said that the administration would be willing to make the farmers made whole. What about the semiconductors? The president today said we are not going to do business with Huawei. What did he mean?
Government contracts.
So
no government contracts with Huawei.
No government contracts. But this excludes the semiconductors that have a great business and that are getting killed. I mean, these earnings reports are coming in pretty messy from the semis because of loss of business from Huawei.
Look, the policy is clear at this point. We're not doing government contracts with Huawei. We're not selling them any items from the U.S., including chips, unless they can get them elsewhere in the global marketplace. That has been our policy, and that's where we're going. Go ahead.
Well, I mean, since you brought up the Navarro rule, I was going to bring up what the Journal brought up this week was the Navarro recession. Pretty harsh editorial by the ed board of the Wall Street Journal talking about some of the destructive policies. And here's a quote, Peter. This is a warning the president should heed, and probably one Mr. Navarro won't tell him. If Mr. Trump can't strike a broader trade deal with China before the election, according to the Journal, he should at least call a trade truce to reduce the damage. Economic expansions don't end on their own. They almost always end due to policy mistakes. Mr. Trump's willy-nilly trade offensive could be the mistake that turns a slowdown into the Navarro recession. Your response?
Well, it's always an honor. I wear it as a badge of honor to be attacked in the Wall Street Journal. Look, the Wall Street Journal is strongly in favor of deregulation and tax cuts, but the Wall Street Journal has never, ever supported our trade policy going back to when Donald J. Trump was a candidate, and we don't really expect them to change their stripes now. I would stand on what I said throughout this entire interview as to why the Trump economy is solid as a rock, why the stock market is bullish. And I wonder where the Journal was, where the Wall Street Journal was from 2001 to 2016 when the president got elected, when we lost over 70,000 factories to unfair trade and over 5 million manufacturing jobs. I wonder, you know, if as the professor here, if I gave a quiz to the editorial writers, whether they could name all 7 of those structural problems that we're facing with China, the cyber theft, the forced transfer,
I'm not sure the criticism is around that. I think the criticism is not around what you're doing. I think it's about the tactics of how you're doing it, the sort of aggressive, ad hoc, surprise tariffs that are weakening the global economy, and now signs that it's starting to impact the U.S. economy as well.
Well, there's okay. Let's talk about this whole notion of it's ad hoc. This is a well thought out strategy. The president has been consistent about 2 things, dating back to the first summit with the Chinese at Mar-a-Lago in spring of 2017. He is always willing to negotiate with the Chinese. His door is open. His phone is ready to be picked up. But if the Chinese do not honor their commitments, or if they renege on a deal like they did, a 150-page deal, he will take action. And so every time tariffs have been put in place by the Trump administration, they have been well signaled to the Chinese in advance. I mean, after all, Mar-a-Lago, we got problems, China. Let's talk. Nothing happened. 301 investigation by Robert Lighthizer. Signal. When this comes out, there might be tariffs. Nothing happens. 25% tariffs on $50 billion. Let's keep talking. 200. So, I mean, look, the Journal has no answer for China. You and I and everybody, I think, watching this show understands that China is engaged in severe structural acts of aggression against this economy and the world economy. What is the answer? The answer is a tough trade policy that we're pursuing. We have done everything to negotiate with the Chinese. We have done everything to bring our allies in to this problem, and we will continue to do so. But at the end of the day, seek truth from facts, and the fact is China keeps doing what it has been doing. They treat us like a piggy bank. They're taking over $500 billion out of the economy every year, and that's where we stand. But maybe this August, when the Chinese go to the countryside for their annual retreat and have their discussions, they'll realize that the best way forward is a solution.
Peter, I wanted to end by going back to the topic of the dollar. The U.S. economy is 70% consumption, only 20% of GDP is related to trade directly. Why is the president so obsessed about a weaker dollar? It doesn't make sense for the U.S. economy in the long term.
Look, I'm not going to answer that kind of question. That's a loaded question. But here's what I can tell you. When the Fed raises interest rates 100 basis points and the dollar rises by 9% and we lose 2/3 of a point of GDP off our Q2 numbers, President Trump is concerned. President Trump gets up every day and he thinks about three things. He thinks about creating good jobs and growing this economy. He thinks about securing our border.
Do you think
and
he's
he thinks
right
about
to want a
national
weaker
security.
dollar, Peter? Do you think he's right to want a weaker dollar?
It's the wrong terminology. The terminology which I prefer to use is whether the dollar is appropriately balanced. And the problem is that when you see the Fed raise interest rates to levels which are several hundred basis points above the rest of the world, and then the dollar goes up by almost 10%, it's undeniable that that harms our export growth. So if
it's
the
not
Fed...
just the Fed, Peter. You know, the trade fight also strengthens the dollar. The U.S., as you guys have said 100 times, is the relative winner in the trade fight. China's hurting more than we are. That drives money into the U.S. stock market, into U.S. bonds, and the U.S. dollar. I mean, you guys are also strengthening the dollar. Do you see that?
I see that a strong Trump economy does indeed attract investment here, and that's a good thing. But at the end of the day, the fact that when we put tariffs on and the Chinese yuan goes down by 12%, that's currency manipulation by any other name. They are neutralizing our tariffs. And by the way, Sarah, when you have these kind of interviews with people who say that consumers are somehow paying the price, just remind them that China devalued its currency by over 10% and see what they have to say. And I'm telling you that Jerry Storch, Google that. That was an amazing
call him
thing.
up.
We know Jerry. He comes on a lot.
All the time.
Have him on.
We're actually going to be talking toys later in the show. Anyway, Peter, and back to your point of the Navarro rule. We say it again. We're always great to have you on the record. Join us, and we appreciate your time this afternoon, Peter.
Very, very good discussion, and I appreciate your willingness to have that discussion. And for investors, just see the chessboard correctly. We've got a strong economy, a bull market. We get the Fed basically to lower interest rates and pass the USMCA. It's Dow over 30,000 by Christmas. And by the way, on CNBC, the day after the election, the morning before the market opened, when the futures were pointing down towards Antarctica, I predicted 25,000 on the Dow based on Trump tax, regulatory, energy, and trade policy. We got there, and now we're going to get to 30,000 and move forward. And this president is the best president in modern history on the economy, and I don't think that's to be disputed.
Peter Navarro, thank you for joining us.
Thanks, Peter.